Chapter 10, Standard Cost and Variances. Hello all. Chapter 10 is all about establishing cost standards for activities and their periodic analysis to determine the reasons for any variances. Smart business professionals set standards and then measure actual performance against those standards. By definition, a standard is a benchmark or a norm for measuring performance. The actual results are what actually happened. The difference between the standard and what actually occurred is called the variance. Variance analysis compares the actual results with the standard set and assesses whether actual results are favorable or unfavorable. The must know for this chapter include 1. How to distinguish between standards and actual results. 2. How to calculate standards and actual results. 3. How to calculate variances for direct materials, direct labor, and variable overhead. And 4. How to determine whether a variance is favorable or unfavorable. We need to begin our discussion by describing the two types of standards. When looking at the cost of inputs, we set spending standards to determine how much should be paid for each unit of input. When looking at the quantity of inputs, we set activity standards to determine how much of an input should be used to make a product or provide a service. The difference between standard costing in manufacturing organizations and standard costing in a service organization is that a service organization has no direct material cost. Both have direct labor and overhead. Our focus for this chapter will be on the manufacturing companies. When setting standards, management should focus on practical standards as opposed to ideal standards. Because practical standards set achievable goals, there are fewer issues with worker motivation, and variance analysis can focus on management by exception. Variance analysis is a straightforward four-step process. First, you set the standard for each operation. Second, you compare the actual performance with the standard. Third, you analyze and report variances arising from the difference between actual and standard performance. And fourth, you investigate significant variances and take appropriate competitive action. When discussing price variances, variances relating to direct materials are referred to as price variances, while variances for direct labor and variable manufacturing overhead are referred to as direct labor rate variances and variable manufacturing overhead rate variances. When discussing quantity variances, variances relating to direct materials are referred to as quantity variances, while variances for direct labor and variable manufacturing overhead are referred to as direct labor efficiency variances and variable manufacturing overhead efficiency variances. Standards for direct material will consider both quantity and price. The standard quantity will be the amount of direct material that should be used for each unit of finished product, including an allowance for normal inefficiencies such as scrap and spoilage. The standard price will be the price that should be paid for each unit of direct materials, and it should reflect the final delivered cost of those materials. The standard direct material cost will be determined by multiplying the standard quantity per unit by the standard price per unit. When comparing actual results to standards for direct materials, the variances will either be a price variance or a quantity variance. The direct materials price variance will use actual quantity purchased to compare the actual price paid to the standard price. There will be a favorable price variance when the actual purchase price paid is less than or equal to the standard price. If more is paid, then an unfavorable variance will be reported. Likewise, to determine the quantity variance, we will use the standard price to compare the actual quantity of materials used for production to the standard quantity allowed. We will have a favorable quantity variance if the actual amount of direct materials used to produce the product is less than or equal to the standard quantity of material allowed for the actual output. If more materials are used, then an unfavorable variance will be reported. Because not all materials purchased will always be used, it's important to realize that the price variance is based on the total amount of materials purchased, while the quantity variance is based on the total quantity used. Let's turn our attention to direct labor. For direct labor, the total spending variance is the difference between the total amount actually spent for direct labor and the standard expected. Variances will either be the labor rate variance or the labor efficiency variance. The labor rate variance will use the actual hours worked to compare the actual wage rate paid, including employment taxes and fringe benefits, to the standard wage rate. The labor efficiency variance will use the standard wage rate to compare the actual hours worked to the standard hours expected to produce the finished goods. When comparing actual results to standards for direct labor, we will have a favorable rate variance when the actual amount paid to workers is less than or equal to the standard rate. If more is paid, then an unfavorable variance will be reported. Likewise, we will have a favorable labor efficiency variance if the actual direct labor hours worked are less than or equal to the standard hours expected. If more hours are worked, then an unfavorable variance will be reported. For variable manufacturing overhead, the total spending variance is the difference between the total amount actually spent for activity levels and the standard expected. Variances for variable manufacturing overhead will either be a rate variance or an efficiency variance. The quantity standard for variable manufacturing overhead is expressed in either direct labor hours or machine hours, depending on which allocation base is used in the predetermined overhead rate. The rate standard for variable manufacturing overhead comes from the variable portion of the predetermined overhead rate. The variable overhead rate variance measures the difference between the actual variable overhead costs incurred during the period and the standard cost that should have been incurred based on the actual activity for the period. The variable overhead efficiency variance measures the difference between the actual level of activity and the standard activity allowed for the actual output, multiplied by the predetermined overhead rate. The rate variance will use the actual hours of activity to compare the actual rate to the standard rate. The efficiency variance will use the standard rate to compare the actual activity to the standard activity allowed to produce the finished products. Just as described for direct labor, a favorable manufacturing overhead rate variance exists when the actual rate is less than or equal to the standard rate. A rate which is higher than the standard will result in an unfavorable variance. A favorable efficiency variance exists when the hours used are less than or equal to the standard hours allowed. If more hours are needed, then an unfavorable efficiency variance will be reported. Variances can be determined using either a model or using equations. This slide shows you the model. As you can see, there's a model for direct materials and a model for direct labor and variable manufacturing overhead. Both models are basically the same in that they identify the variances related to price and quantity. The direct materials has four components because in most cases, the amount purchased is not equal to the amount used. In both models, the first box multiplies the actual quantity or actual hours times the actual price or actual rate to get the actual amount spent. In both cases, the last box multiplies the standard quantity or standard hours times the standard price or standard rate to determine the standard cost. The calculations between the first and the last box allows you to determine the total spending variance and to break that total spending variance into both a price or quantity piece. Using equations to solve problems will be faster than using the model. Both will result in the same answers. This slide shows the 6 equations needed to determine the variances for direct material, direct labor, and variable manufacturing overhead. A closer look will reveal that there are really only 2 equations that you need to understand. The bottom line is that all variances are related to either price or quantity or both. The price variance will always be the difference between the actual price and the standard price multiplied by the actual quantity. The quantity variance will always be the difference between the actual quantity and the standard quantity multiplied by the standard price. Simplifying the math this way will allow you to better understand your calculations. This will make a lot of sense once you complete some drills. Just like everything else that we have studied, there are some key advantages and challenges when using standard costing. Setting standards and analyzing variances has several noteworthy advantages. One, doing so encourages management by exception with a focus on improvement in areas that need improvement. Two, benchmarks can be used as an evaluation tool if viewed as reasonable by employees, promoting operating efficiency. Three, the process encourages responsibility accounting as responsibility and accountability can be assigned to various department heads. Like everything else studied, the process also comes with potential challenges. First, reports may not be timely. Standard cost variance reports are usually prepared on a monthly basis, hence, they may contain information that's outdated. Second, there's a potential to use negative reports to punish employees. This may cause morale issues and employees to make dysfunctional decisions. Third, efficiency variance assumes labor is variable. Labor variances make two important assumptions. First, they assume that production is labor paced, so that if labor works faster, output will go up. Second, they assume that labor is a variable cost. These assumptions are often invalid in today's automated manufacturing environment, where employees are essentially a fixed cost. Fourth, favorable variances can be interpreted as good, but in actual fact may not be what is best for the company. Fifth, too much focus on meeting the standard may make quality suffer. And finally, six, just meeting the standard is not good enough. The goal is constant improvement to survive in a competitive environment. This slide illustrates the variance analysis cycle. As you can see, the process starts with current operations, followed by reports showing actual results compared to standards which have been set. Variances are identified and analyzed. Questions are raised, root causes are identified, and actions are taken. This process never ends. So that's it for chapter 10. Thanks for watching this video. Time for drills. Good luck.